Welcome to Quiet Wealth Lab. Today we're tackling one of the biggest questions every aspiring entrepreneur faces. Where do I get the money to start my business? Whether you're sitting on a brilliant idea or you've already started sketching out your business plan, funding is the bridge between your vision and reality. In this video, we're going to walk through 5 proven strategies for raising capital, from bootstrapping with your own savings all the way to leveraging other people's money through strategic bank loans. The average cost of starting a business is around $40,000, and with over 150 million startups worldwide, competition for capital is fierce. But here's the good news. There are more pathways to funding than ever before. Let's dive in. Here's our roadmap for today. We're covering 5 key funding strategies, and I've ordered them in the sequence most founders actually follow on their wealth-building journey. We'll start with bootstrapping, using your own money to get started. Then we'll talk about angel investors, those individuals who step in early when banks won't touch you yet. Next, we'll discuss building assets, because your balance sheet becomes your most powerful tool when you need bigger capital. Then we'll get into bank loans and the real numbers behind approval rates. And finally, we'll cover a strategy that separates wealthy entrepreneurs from everyone else, using other people's money, even when you have your own. Stick around for that last one. It's a game changer. Let's start with bootstrapping. And this is where most successful businesses actually begin. Bootstrapping simply means building your company using your own personal savings, the revenue your business generates, and good old-fashioned sweat equity. No investors, no debt, just you and your hustle. Now here's a stat that might surprise you. According to Gallup, 77% of small business founders cite personal savings as their primary funding source. That's more than 3 out of 4 entrepreneurs starting with their own money, and the results speak for themselves. Bootstrap startups are 3 times more likely to be profitable within 3 years compared to venture-funded startups. They also have a 55% higher chance of reaching break even within just 2 years. Why? Because when it's your money on the line, you make smarter decisions. You're more disciplined with spending, more creative with solutions, and more focused on revenue from day one. So how do you start? First, determine your target amount. How much do you actually need to launch? Then start saving consistently. Be patient but firm. Keep meticulous financial records from the very beginning. And here's a pro tip. Save with the banks you plan to borrow from later. Building that relationship early pays dividends down the road. Now let's talk about angel investors. These are wealthy individuals who invest their personal funds into early-stage startups, often at a point when traditional banks and venture capitalists consider the risk too high. They're called angels for a reason. They step in when nobody else will. So what do the numbers look like? The typical angel investment ranges from $25,000 to $100,000 per deal, with the U.S. average sitting around $75,000. In exchange, expect to give up between 5 and 15% equity in your company. There are over 66,000 active angel investors in the United States alone, and about 68% of angel investments go into technology, healthcare, and fintech sectors. But angels aren't just writing blind checks. They want to see a clear business plan, evidence that you've put your own money in. That's the skin in the game factor, and proof that your idea has market potential. Your earlier financial records from the bootstrapping phase become incredibly valuable here. They show discipline and commitment. And remember this, if angel investors gave their money away easily for every unconvincing idea, they wouldn't be wealthy for very long. Treat the pitch process seriously. This slide is about something many new entrepreneurs overlook: building your asset base. Think of assets as your future collateral. They're what banks look at when deciding whether to lend you money. The stronger your balance sheet, the more capital you can unlock. Let's break down the 3 types. Fixed assets are your long-term. Tangible resources, property, machinery, equipment, things that hold value over time and can be pledged as security for loans. Current assets are your short-term resources. Cash in the bank, accounts receivable from customers, physical inventory. These show that your business has liquidity and can meet its obligations. Then there are intangible assets, patents, trademarks, copyrights, and brand equity. In today's economy, these are often the most valuable assets a business can own. Think about how much a strong brand name or a proprietary technology is worth. My advice: start acquiring assets early, even if they're small. A piece of equipment, a small property, even building up your cash reserves. Every asset on your balance sheet strengthens your position when you walk into a bank or sit across from an investor. Now, let's get into bank loans. And I want to share some eye-opening statistics with you. The approval rate at big banks is just 13.8%. That means roughly 86 out of every 100 applications get rejected. Small, community banks do better at 19.1%, and alternative lenders approve around 28.3%. The average small business loan is about $663,000, while B, a 7A loans, which are government-backed, average around $539,000. But here's what most people don't realize. Small banks fully fund 57% of the applications they approve, compared to just 43% at large banks. That's a 14-point gap. So what do banks actually look for? 4 things: clean financial records, demonstrated financial management ability, solid collateral, and a well-thought-out business plan. Your personality and character also matter. Bankers are lending to you as a person, not just your spreadsheet. One more thing. Credit unions lead borrower satisfaction at 76%. They're often overlooked, but they can be excellent partners for small business lending. The key takeaway here is to build your banking relationship early. Don't walk into a bank cold when you need money. By then it's too late. And now, for the strategy that truly separates wealthy entrepreneurs from the rest: using other people's money. This is a principle that the most successful business owners live by. Even when you have the personal funds to invest, use bank financing instead. Why? Because it preserves your capital as a safety net, and it forces external accountability. When a bank reviews your loan application, they're essentially giving your business idea a stress test. They'll scrutinize your plan, identify weaknesses you might have missed, and challenge your assumptions. That's free due diligence. The smart play is a CO investment strategy. Split your funding between personal capital and bank loans. This way, you share the risk while maintaining enough liquidity to weather unexpected challenges. And here's a powerful litmus test. If banks refuse to lend to you, take that as a serious signal. If professional risk assessors don't believe in your idea, you should think twice before putting your life savings into it. Only invest what you can truly afford to lose. Remember, 90% of startups fail, regardless of their funding source. Smart capital structure, knowing when to use your money and when to use someone else's, is your best defense against becoming a statistic. Thanks for watching Quiet Wealth Lab. If you found this valuable, hit that subscribe button and share this with someone who's thinking about starting a business. Until next time, build quietly, build wisely. And that wraps up our 5 strategies for funding your business. Let's quickly recap what we covered. First, bootstrapping. Start with your own savings and build discipline from day one. Second, angel investors. Find individuals who believe in your vision and are willing to back you early. Third, build your asset base. Every asset on your balance sheet makes you more bankable. Fourth, bank loans. Know the numbers, build relationships, and present a solid plan. And fifth, use other people's money strategically, even when you have your own. If you found value in this video, do me a favor and hit that subscribe button. We put out content every week on Quiet Wealth Lab to help you build wealth the smart way, quietly, consistently, and strategically. Drop a comment below and tell me which funding strategy you're most interested in exploring. And if you know someone who's thinking about starting a business, share this video with them. It might be exactly what they need to hear. Until next time, build quietly, build wisely, See you in the next one.